Hi guys, today we're looking at the RSI, which stands for the Relative Strength Index. It's a momentum oscillator that you can put on the bottom of your chart. So you see I've got it here at the bottom. It measures the speed and change of price movements and oscillates between 0 and 100. So you see it's not actually showing the 100, but we've got a 0 below here and 100 here, and it oscillates between these two values. And it basically shows the strength of a market. Essentially, it's calculated based on the average gains and the average losses over a specific number of periods. The most common amount of periods is 14. There are also two critical levels which signal overbought and oversold. So you can see here we've got 70 and we've got 30. Now these can change. You can change these manually based on the volatility of the asset, but traditionally, at least for most FX, we tend to stick with 70 and 30. Or when the RSI goes into these areas, it suggests that the market here, for example, is overbought, and down here it's oversold. How do we actually trade the RSI? So there are a couple of different ways. Obviously, we've just mentioned the fact that the market might be overbought and oversold in these areas. That's not in fact a buy or sell signal. The signal is actually when it crosses from overbought back below the 70 line. So here, that there is the sell signal, and vice versa. A buy signal would be this crossover back over, not the one down, the one back over. So that would be a buy signal. Another signal is using the center line. So when we're above it, we're looking to buy, and it's basically giving us an indicator that this market is trending higher. So it's not a buy signal, but this would point us in a direction that this market is trending higher, and we would basically be looking for buys. When it's below it, we'd only be looking for sells. The final technique we can use in an RSI is divergence. So you can see here we've got a higher high and we've got a higher low. Here we've got the same high, so we're seeing divergence here, and the low here is taking out this low. So this low is lower than this versus this low is higher than this one. So this is suggesting that the market is slowing, and we may well start to see it peter out and come off again. Now in choppy markets or sideways markets, again, like a lot of oscillators, the RSI gets tripped up. So it does start to give us false signals. So in this kind of area, it's not really giving us too many signals. You can see that it came over to the buy side, to the sell side, to the buy side, to the sell side, to the buy side. All of which not really helping us with our trade. Similarly to other oscillators, we should always be using it as a secondary indicator. So use a primary indicator like support and resistance, like a candlestick or a trend line, to signal your trade setup, and the RSI should confirm it. So if, for example, you're looking for a buy here, you would potentially draw a trend line on, and then whenever this market comes back to this trend line, this becomes a buy zone, and you would be hoping to see this market ideally not overbought and coming back up into that sort of area. Hope you guys enjoyed looking at the RSI today. Thanks very much, and I'll speak to you again.